Hello everyone, this is Bunty Chawla tracking BFSI sector with IDBI Capital. So today RBI has came out with a policy. So it's a surprise policy in the month of May. So key highlights on that: the MPC meeting met on 2nd to 4th May, and based on assessment of current and evolving macroeconomic situation, they voted to increase the policy repo rate by 40 bips to 4.4% and CRR by 50 bips. It continued to remain accommodative while focusing on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. The decision of this MPC today to raise the policy may be seen as a reversal of the rate action of May 22, 2020 in keeping with the announced stance of withdrawal of accommodation set out in April 2022. So what are the rationale for increasing the rates? Globally, inflation is rising alarmingly and spreading fast. Also, geopolitical tensions are ratcheting up inflation to their highest levels in last 3 to 4 decades in major economies while moderating external demand. These developments would have ominous implications for emerging economies, which is including India as well. So global growth projections have been revised downwards by up to 100 bips for this calendar year by IMF. These dynamics pose upside risk to India's inflation trajectory set out in the MPC resolution in the meeting April 2022. So what is our view? Our view, surprisingly, RBI out of turn has increased the repo rate by 40 bips with the expectations of inflation could turn much higher than estimated for the April data. This should result into an increase in repo rate linked loans. For example, ICICI Bank has 41% of domestic loans linked with the repo, especially home loans and vehicle loans. This should have a positive impact on the margins. However, CRR hike by 50 bips to 4.5% should have a negative impact on the bank's margins as they have to keep higher liquidity with zero interest rate. While on NBFCs, it's clear cost of funds will rise going forward. Thus, depending upon each portfolio mix change and pricing power for their and specific NBFCs, margins will get impacted depending on the specific financials. Lastly, what will be on market? On market per se, we believe the global liquidity has been sucked from the market with respect to Fed bond buying, along with the RBI taking measures to reduce the liquidity into Indian system will have a negative impact in short term, for example 2 to 3 months kind of a thing for stock markets. However, we believe for longer term horizon we should invest in good quality stocks going forward for a good portfolio return as such. Thank you.